Well, uncertainty remains, and that is only ongoing guarantee. That's the view of Michael Houghton from Lucerne Investment, who expects FY24 to be a challenging year, particularly after the past financial year generated for traditional asset classes. Michael joins us now to discuss his outlook. Michael, good to catch up with you. Thanks for joining us again at AusBiz. Of course, so much of what's being driven by investors at the moment and broader markets is what's going on with central banks. That has been the case, given the rapid rise in interest rates. From the outset, we will take a global picture, but what's your view of what the RBA is likely to do today or what they should be doing?
I think they're likely to hold rates today. I think and that's the accepted view, as you've just said. I think that's probably acceptable. There is still, though, a much higher inflation than they want. I think 4.9% was the July reading, where the target for the RBA is between 2 and 3% on an ongoing basis. And if the interest rates were to stay where they were today, we still expect there's probably another 1 to 2 rate rises because they're just not bringing inflation down fast enough. This is probably not the neutral rate. Or if it is to be the neutral rate, they probably have to go a little bit higher to actually have an impact on inflation and to see it come down to that band that they're targeting. And if you don't want inflation to stay around for much, much longer, then they've probably got to look at increasing rates, in our opinion, at least once or twice more over the next couple of months.
Whereas more globally, we take a look, I just mentioned the ECB, the outlook there, perhaps they'll leave rates on hold this month, but maybe another hike before the end of the year. Of course, some economies there, in particular Germany, struggling. And the Fed, Michael, what's your outlook there? Because certainly that message has been rates will be higher for longer. How is that likely to impact investment outcomes, do you think?
Well, I think the biggest impact, and you're right, the Fed Reserve in the US has been very clear that rates are going to remain higher for longer, and that this is what markets should expect. And the RBA is probably even going to try to make similar commentary. It wouldn't surprise me to see the comments after today's meeting with the RBA saying something similar. And the impact for that, whether it's in the US here or even in Europe, and it's probably having as bigger impact immediately in Europe as it is anywhere else, is that it's just going to be more expensive for companies to borrow. It's going to become increasingly difficult for them to support their debts. It's going to be harder for consumers as well to continue to make discretionary spending a priority, and they're going to be tightening their belts. And while there is big savings pools in each of those, particularly the US and Australia, they are dwindling, and people are probably going to try and retain those for as long as they can. So from our perspective, corporate debt is a real consideration. There is certainly quite a few what's called zombie companies out there at the moment, where essentially their interest bills are now starting to exceed their income. And as I said earlier, consumers are going to be tightening their belts and focusing on directing their income or their savings to things that are important to them, such as meeting their mortgage and essential living expenses.
So have you there at Lucerne then wound back any exposure you have in that particular sector, have you?
Yes, definitely. More so corporate credit. Like, there are still good opportunities within the debt market, particularly in first mortgage loans over strong property transactions. But in the mid-tier corporate market in particular, we are cautious. We've reduced allocation to zero in that space. There's a few reasons for that, but primarily it's back to what I just mentioned earlier, the ability of companies to support ongoing their debt is going to become increasingly difficult, and we'd rather not try to pick the best opportunities. We'd rather just watch and see what happens in that space over the next 6 to 12 months and see where we can start deploying capital after that period. Because at the moment, for a similar return, we're getting we're taking much lower risk in other sectors of the market than corporate credit.
All right, so that's what you're avoiding. Then, Michael, what is the alternative? What are you then reaching out for in terms of upping your exposure?
Yeah. Well, we are an alternatives manager. We don't invest typically in direct or long only type investments. So what's working for us and what we're continuing to allocate to is long short managers. Long short managers in particular are very, they're difficult to find the good ones. What we look for when we're looking at that space managers who have a particular skill set or a particular theme that they're looking to invest in, and the way that they position that. And not every long-short manager is able to achieve outcomes either on their short book or their long book that gives them good returns. That's an area, though, that we have been getting some success for investors recently, and we'll continue to allocate and look for good opportunities in that space as well.
Yeah, how did you go over the course of August, obviously, when we saw that equity rally come to an end? Did you manage to outperform?
We did, yes. Very pleasingly, contributions from our long-short managers from some volatility strategies that we're allocated to has seen our flagship investment vehicle probably up about 2.5% for the month of August, which compared to a flat US market and a down, I think, about 2% Aussie market is very pleasing indeed. But that's also a function of staying to the themes that we've identified and finding the best opportunities within those areas.
Yeah, just talk us through those themes then you've identified. One of the key ones, of course, being volatility.
Yeah, well, volatility is interesting, and I was looking at the VIX this morning, and it's over the last week, it's come down from about 17 to 13, and for us, that's quite surprising because it's indicating there's complacency from investors in markets, particularly equity markets, because that's what it represents. We're not as complacent as that, as you've probably heard from the things that I've been saying. VIX at 13 is on the longer term low type end of the curve. We don't think things are that settled. We don't think markets should be pricing in that level of complacency, basically. So we've looked at a couple of ways to participate in what we think could be a more uncertain, as you introduced, or volatile time in equity markets in particular over the next 6 to 12 months. Part of that's volatility futures. The other part of it is credit default swaps, which are also fairly benign too in the way that they're being priced, and that's a good proxy for equity volatility too. So we're participating in both those spaces at the moment.
Michael, interested to get your view on China. Of course, remains an ongoing concern given the growth or lack of it that we're seeing there at the moment, and clearly what's happening in the property sector. Policy stimulus, they're pretty much it's been drip fed at the moment. What's your outlook?
Yeah, it's been a surprise, I think, that there was an expectation probably 6 months ago that China would be more aggressive in its stimulus. A lot of investors, I think, position portfolios expecting that to occur. They've been very slow in rolling that out, and probably to the detriment of some of the bigger organisations there. China's also no longer the destination it was for manufacturing. Other countries are now starting to pick up a lot of that offshore work. But the biggest issue has been their property sector. Evergrande has been a real problem for a couple of years now and continues to be a problem. But then Country Garden, another big property developer in China, has also come out of left field, I think, for some people, particularly they're filing for bankruptcy in the US with some of their US assets. That's also had a flow-on effect into how China's being perceived and what they need to do. And there is a real concern that within China, the property sector in particular, more so for the residential buyer, has become a real difficulty with values falling considerably. Their ability to settle on those purchases that they've made or service them has become increasingly difficult. So we're very cautious about what to expect from China, and we think that drip feed approach to their stimulus probably could be a little speedier, but it's not a market that we've been exposed to for those reasons over the last 6 to 12 months.
Yeah, interestingly, you talk about what's going on there with property, and they're now indicating perhaps that they're going to ease restrictions on property purchases. Is that sort of tinkering around the edges, or do you think it's going to have a real effect?
Well, it's probably it's a start. Tinkering around the edges, probably. The effect will only be noticeable, I think, if it has an ability to alleviate some of the pressure that those residential purchasers are facing. And I don't think there's enough attention or enough airtime being given to some of the difficulties that they're experiencing. It's a different market. I'll have to confess, I'm not an expert on it, but the one thing that I have become aware of in looking at it is they have a different way of approaching purchases. When you purchase off the plan, you actually are settling prior to receipt of your property. Once you get the property, the valuations are considerably lower, and then the ability to sell that becomes difficult, and you've got a debt that's in excess of the value of your property that the purchaser's unable to support. They can't rent it, they can't sell it, and I think that's where, yes, some support definitely needs to be given to that, but maybe more than what's initially flagged.
Michael, great to get your outlook there. Thanks so much for joining us from Lucerne.
My pleasure. Thank you, Andrew.